taking a bet, whether you think you are or not. And so, you know, as you've mentioned, if you go to the previous chart and you look at those periods in the 70s and whatnot, you'll probably see the biggest adoption of, you know, trend following futures in 1979 and 1980, because they'd outperformed the dominant, you know, equity index. Much like you may be seeing that day in the dominant equity index having pretty large and broad adoption in private equity and those types of things. And you know, you look back at the last 10 years and you say, well, why would I own any of those other things? They've done nothing but reduce my potential returns. And this is, I mean, this is performance chasing at its best. It's that, you know, behavioral bias, you know, how can I do things that haven't done well? How am I going to sell that to a board? How am I going to put it in portfolios? How do you, as an advisor, you go in, someone comes into your office and you say, okay, we need, you know, you need 30% exposure to these alternative asset classes. And they say, well, show me how that's done over the last 10 years. And you show them an equity line that is substantially below the simple strategy of buy and hold. And so that's really, really a difficult conversation to have at all levels of strata, whether it's institutional, retail. This is a really tough conversation to have. And you've seen that consistent narrowing of opportunities in the IPSs broadly across all of those that continuum of asset owners.
Yeah.
And so, you know, this happens over and over again.
Yeah, and we haven't seen inflation, but we also haven't seen prolonged bear markets, right? So precisely. I think the interesting part of this is that I just went through those charts, right? And I'm going to go through them again, but just highlight, you know, as you mentioned earlier, Mike, when there's this type of inflation volatility, there are a lot of bear markets. And so how do these multi-asset strategies do in bear markets? Well, they do really well, right? 82% positive returns during the credit crisis bear market in the Goldman Sachs index, 28% positive returns during the '08 crises. And then
I think that's you mentioned, it's the tech crisis that you mentioned first. Just for those listening, yeah, 82% versus 47 down in the tech crisis. And then, you know, 53% decline in the great financial crisis versus 28% for the global macro. Sorry, go ahead. Just
yeah, and for those in the 70s, during that mid-70s bear market, that was a 42% correction in the S&P. And
that's nominal.
That's nominal. And then you had the AQR index up 138%, right? So we just haven't experienced these like good old-fashioned bear markets. And a lot of this space has been vilified because they haven't done fantastically well in really abrupt liquidity shocks. But that's not what they're designed for, right? If we go back to these traditional ones, I think they will perform really, really well. And now you gotta, so one of the best things about all of this is just going back to that target chart is you may be able to kill two birds with one stone, right? You're not just, we started this conversation with inflation protection and what could offset it. We showed that possibly the best option is multi-asset, long short. And then by happenstance, we stumbled upon the fact that, oh, they also solved the bear market issue. So I think we got to stop thinking about particularly the multi-asset space as a just an alt that you want to have a nice to have a little bit of extra juice, and more about a pillar of portfolio construction. Not a 5% allocation, but kind of think about it from a risk parity lens and say, okay, you got your equities and you got your bonds. Everybody knows those. I got a third thing that the purist risk parity guys tell me I should have commodity purely, but I know that's not going to work. This may replace commodities and actually do a better job, right?